Thank you very much. And thanks, everyone, for coming back from the break in a timely fashion. So I am a partner at Stikeman Elliott. My practice focuses on all sorts of financial services, regulatory, including compliance and M&A in traditional financial products and services, as well as fintech, regtech, including crypto, trading infrastructure, et cetera. I am joined by an esteemed panel, and they're going to introduce themselves as we launch into the first question. Of course, our topic is one that was a hot topic a number of years ago. It was quite the rage, particularly exchange-traded products, or ETPs or ETFs, depending on how you like to refer to them. I'm from Canada. We were a trailblazer when it came to approving some of the first crypto-based ETFs, quickly engulfed and taken over by other jurisdictions, including the US. And there's a lot going on in this space, and maybe not as hot as the topic used to be a few years ago, but still lots of interest. So with that, I'm going to turn to my panel. And so first, we're just going to go, maybe we'll go in the order that I'm seeing you guys. So Joe, Charles, and Nick. As we look at the landscape now, mid-2026, what do you see in your respective jurisdictions or your spaces as the most significant developments and how traditional financial institutions and corporates are accessing crypto assets through these regulated structures, so ETPs and digital asset treasuries, and what has changed most meaningfully in the last little while? I know there's been lots of change in the US, so why don't we start with you with that question, Joe?
Thanks. I'm Joe Hall. I'm a partner at Davis Polk. I represented Grayscale in defeating the SEC and getting Bitcoin ETFs in the US. And I also represented the underwriters on all of Strategy's offerings for about 5 years from the very beginning of that product, that DAT product, to what it is now. And I'll qualify this by saying I'm a lawyer, and these folks are bankers. So I can speak to, and I'm a U.S. lawyer, and as you know, we're quite balkanized, so I can speak to sort of U.S. regulatory issues. But I think over the course of the past year, in the U.S. at least, the biggest change was the adoption by the SEC of so-called generic listing standards for ETPs, for crypto ETPs in the United States. And the significance there is prior to these so-called generic listing standards, every time you wanted to bring a new product to market, you had to go through it's called a 19b4 rule change procedure at the SEC, which could stretch out for almost a year, with the staff sort of substantively reviewing and commenting on the plans for listing a new product. And it was an enormous bottleneck for these products. With the adoption of generic listing standards, that's moving us more towards sort of the same model that we have for regular equities, where if somebody wants to list a brand new share of common stock in the United States, they don't have to go through a lengthy, drawn-out procedure with the SEC, to approve just basically, the concept of the market actually trading this thing. Instead, the SEC has now said, okay, as long as they meet, 2 or 3 criteria, we're going to go ahead and allow these things to be approved for listing. Now, the issuer still has to go through a review of its registration statement, but that's quite different from the SEC looking at sort of the market structure for these products, which is what had, originally held up the Bitcoin ETFs. And so with these generic listing standards, we have seen just a rush of new ETPs, Solana primarily, but you've also seen, I believe, Doge and Litecoin and others, and you're going to continue to see those. So that's been a huge sort of change in the past year in how these products operate in the United States. The well-publicized and ongoing, changes to the regulatory agencies, following the restoration of the Trump regime, has completely flipped the script on the regulatory posture towards crypto in general. The new SEC under Paul Atkins has been, very open, aggressive, you might want to say, in sort of like getting people or telling the market that particular assets are not securities, which is quite relevant both to the viability of that asset in the secondary market, but also to the SEC approval process. So a number of these products that you have seen move to ETP status over the last year, including SOL, I would also say including LTC and maybe even Doge, are only possible because the current SEC does not view them as securities. A huge reversal from the Gensler era SEC, which came to a close on January 20th, 2025. Now the problem that is still in the United States is just like during the Gensler era. We had a regulator sort of sitting up there, just sort of like opining that all crypto, virtually all crypto were securities. So far in the Atkins era, we kind of have the same thing in reverse. And what I mean by that is the law in the United States hasn't actually changed yet. We're still stuck with the Howey test, which people have heard of. And we're still stuck with, 4 years of the Gensler SEC, and before that, 4 years of the Clayton SEC, bringing cases in the federal court system, articulating a view of what is a security under U.S. law versus what is not a security. That fundamental law hasn't changed. So what has changed is sort of a regulatory enforcement posture. We have in the United States a piece of legislation pending, the Clarity Act, which may or may not get enacted this year. And if it does get enacted, that will, just like its name says, that will bring clarity to the issue of whether an asset is a security or not. But until we actually get a legislative change and we move away from sort of a common law approach to what is a security and what is not a security, all of these products, really even including the ETH products, are going to sort of carry this long tail risk that the underlying asset might actually be a security. And if that underlying asset is a security, then all these ETPs are illegal assets, as are most of the DATs. Bitcoin might be a difference, but really everything other than Bitcoin. So that is still pending. You might know that we have a lot of problems with our current Congress, a lot of problems with our current politics. So whether or not the Clarity Act actually gets passed, to me, is a big open question, but that's the biggest thing that I'm watching right now. One other thing I just want to mention is this is more of a commercial thing as opposed to a regulatory thing, but I think kind of the fact that strategy has kind of, the MNAV of strategy has gone below parity, it's below 1%, meaning that the strategy is not necessarily trading at a premium to its net asset value anymore. I think that's pretty ominous in terms of the development of the DAT market going forward, if not the ETP market. So I just highlight that. But the interesting thing is, even though we've been in a terrible slump in crypto over the past year, we have still seen pickup, particularly with the SOL product. I think you maybe have seen outflows with Bitcoin and ETH, those products. Although some of that may be related to people wanting to get in on the SpaceX IPO. But the fact that SOL was able to actually launch and sort of gather assets during this period of a declining price, I think is a very positive sign for the market, suggesting that this isn't just sort of momentum trading, and there are actually some structural reasons why institutions and retail want to be in these products.
Fantastic. Well, thanks for having me. I'm Charles Adams, and I'm Head of Investor Relations at Nickel Digital Asset Management. We are a London-based investment manager that offers a range of solutions for primarily institutional investors to get exposure to the digital asset space. Our main one is a multi-manager vehicle, which is operating across. We've got managers in 36 different countries now, and investors pretty well located around the world. And no, agree with everything you said, and it's certainly been a huge revolution over the last.
Mouthing platitude.
Yeah, I think that was like the ETF moment in the US was a watershed moment for everyone. But even going back before that, I think the biggest change over the last maybe 6-7 years is that there are lots of different options for institutions to look at. Options from a product perspective, a range across Europe and America and Singapore and Hong Kong, Back in 2020, just after the FCA restricted access to ETPs here in the UK, we got asked to launch a hedge fund that just bought Bitcoin and stored it with Fidelity. Probably the most boring hedge fund in the history of hedge funds. And that was just because access was just so tough for investors that wanted to get exposure, and they didn't know where to go, they didn't know what to buy, they didn't know who to buy it from. And now you look around and there are a vast range of options for institutions to get access. And there's also a huge range of options on the regulatory side of things. I don't think I've ever seen a sector with institutions that are so mobile when it comes to regimes. I've seen big American institutions move their kind of digital asset or DLT working group or teams from New York to Malta to Zug in Switzerland, from there to the DIFC in Dubai, and then from there to Singapore under the MAS, and now back to New York. And I think that is it's a really interesting development. If I look at the last 12 months, I think the most interesting thing has been, in the last 10, 15 years in this sector, every time the price goes down by 50%, it doesn't matter what you were doing in the space, whether it was to do with the actual assets itself, blockchain technology, interest disappeared. The FT wrote an article saying Bitcoin was dead, and suddenly the blockchain working groups got quiet, and the all-party parliamentary groups working on the space, they got quiet as well. It was actually in the last, 8 months, we've seen Bitcoin go down by 50%. We've seen a lot of negative press attention, but the big banks that I speak to, the pension funds, the endowment funds, they're completely unfazed. Whether they're looking at tokenized assets, prediction markets, buying digital assets of some sorts, they have been completely unfazed, and they are still looking at the sector. And that's the first time in the industry's history where that's been the case. And I think that is, that's a product of Trump getting elected, not him himself, but actually digital assets being on the agenda and being a big part of his election campaign, whereas in 2016 he was anti the space and anti-crypto, anti-Bitcoin. I think the ETF launch in the US, and perhaps more importantly, the success of that launch, played a huge part of it. 10 years ago, I could go around speaking to pension funds about digital assets, but having Larry Fink at BlackRock, having Jenny Johnson at Franklin Templeton saying that tokenization is going to be the next biggest thing in the financial sector, that is going to drive a hell of a lot more adoption than I'm going to be able to do by myself. And I think that is the biggest change in the last 12 months that I've seen.
And anything on DATs in terms of your clients?
So we'll probably speak a lot more about DATs, but I think the interesting about DATs is, it's like, first of all, why did DATs exist, right? DATs were formed as some innovative companies thought, actually, we should have 2% of our balance sheet in something other than sterling, something other than dollar. And then as soon as they did that, they realized that their share price didn't just move, it moved monumentally to the upside. And then when they looked at why, they realized that all these retail investors that wanted exposure to primarily Bitcoin, but also other digital assets, had nowhere to buy it from. If there's no, especially in the UK when there was no ETP, suddenly, you could buy Tesla in your stocks and shares ISA and have tax-free gains. And if that trades as a proxy to the digital asset that they hold on their balance sheet, then it was a workaround. And then, of course, that evolved and evolved and evolved, and we find ourselves where we are today, which is a very different landscape. And I think, although the majority of DATs are uninvestable for their original purpose, they don't track the underlying asset which they're holding, there is still some interesting opportunities for larger investors. So I speak to a lot of investors that are interested in effectively taking advantage of these DATs which are trading at a discount to the assets they hold. That's an interesting opportunity. It's not an opportunity that they were meant to arise from DATs. And then I also think that there are, on a retail perspective, and I think there's going to be a lot of negative regulatory repercussions from this, the most successful DApps seem to be the ones that are innovating by offering effectively hedge fund exposure to retail investors. Some of the larger ones, that's exactly what they're doing. They're saying, buy our share because you will get exposure to the underlying asset plus 10 to 15% a year. And I think that is, it's an innovation. It's definitely an innovation. Whether that sticks around, whether regulators don't stamp that out, I'd be very surprised. And a history of digital asset companies offering too good to be true yields to retail investors. Sadly, we've got a history of it, and it didn't end well the first couple of times, and I don't expect it to end well this time. But there is, hundreds and hundreds of DATs that have raised billions of dollars. There are some very interesting opportunities out there for the investors that are sophisticated enough to take advantage of it.
Thank you. Over to you, Nick.
Yes. So I'm Nick Jones. I'm the CEO at Zumo. We are we were the fourth company registered under the FCA's crypto assets regime here in the UK back in 2021. So fairly been through 3 market cycles, I think, in the space. Pivoted from a direct-to-consumer app business that we wound down successfully, returned user funds and FCA oversight, et cetera, and repurposed the business into a B2B business where we now offer a crypto as a service product. If people are familiar with the zero hash model in the US, so all the elements that a financial institution needs to launch digital assets products, we can provide those via API. So we're working with companies in TradFi, we work with other crypto companies in the kind of quasi-institutional wealth management space as well. So offering custody, trading, fiat on and off ramp, all of the kind of peripheral KYC, AML services that go around with that, and focused in the UK, but also internationally. So yeah, super interesting hearing everyone's reflections. At the risk of being slightly controversial, I would suggest that Trump's renewed enthusiasm for crypto is because he worked out how him and his family could make a lot of money out of it the second time round.
Nobody's really saying.
So I think that would probably explain the sudden enthusiasm. But yeah, I think we're in an interesting moment in the UK. We've been 5 years into a kind of quasi regulatory regime, which has morphed from being something which looked like the e-money regime into now something which will bring us under the auspices of FSMA. So we'll be being managed and overseen like any other investment firm, with a very, very high bar to become authorised, and then significant operational flexibility once you're through that authorisation process. And there's no doubt that the FCA's taken a cautious approach. Most people would say slower than we would have liked. There would have been, had there not been a government change, whenever that was, 2.5 years ago, we probably would have had a regime in the UK then, which may have been slightly different to the one that's come in. But we have what we've got to work with, and look, it definitely leans into London and the overall thesis of the kind of institutional use cases. The regime is still not going to be particularly friendly for companies trying to offer anything other than spot and maybe a bit of lending and borrowing, maybe, and some staking to retail investors. And the ETP thing, where we had a big fanfare around ETPs were going to be available for retail investors, and they were going to be available as stocks and shares ISAs, and then there was a flip-flop, and they're in the innovative products ISA piece, which is great, except you can't buy innovative product ISAs from anyone as a retail investor in the UK. Gives you a kind of a feeling for the level of caution around this, whereas of course, ironically, for most retail customers, exposure to something like an ETF probably makes much more sense than randomly going on Coinbase and buying a load of tokens, some of which, probably 90% of which are useless and will go down in value. So it's an interesting kind of unintended consequence of the regime, is that actually the risk level for retail investors is probably higher by only being able to buy the underlying assets. So it's an interesting position, but we are broadly positive around the steps around the authorization regime. I think it will particularly allow the kind of nascent activity that's been happening around the edges, with institutions getting involved, starting to do things like, if you've got Lloyds doing tokenized deposit projects on Canton, I don't know if there's anyone from Lloyd's here, hopefully not. But I remember being at a meeting with Lloyd's about 4 years ago, and they were still debating whether cloud computing was a good idea. So it's quite amazing that 4 years later they're doing on-chain tokenized deposit projects. So there's been all of this kind of activity going on around the fringes with institutions dabbling in tokenization, dabbling in exposure to ETFs, and there is massive amounts of pent-up demand in the UK, and still huge amounts of flow, obviously, and massive amounts of liquidity. So I think we're bullish. We think that this is going to be the unlock, and that this will be the kind of the floodgates opening for institutional adoption, because I think most institutions have realized the benefits of the underlying technology, whether that's kind of front, back, or middle office benefits of the underlying blockchain piece. They've all been doing some quite wacky stuff in the background or in jurisdictions where they can. Atomic swaps being used for internal FX programs. There's lots of very interesting stuff that's happening. We just haven't necessarily seen it being surfaced in the UK, because it's been not a good idea if you're a bank to go to the PRA and mention that you're doing anything with crypto, because the kind of exec or non-exec management of those functions at the bank has not been particularly keen on the space. I think it's probably fair to say, but it's changing, and probably the best example of that, and I know it's not exactly ETPs, but has been the evolution over the last 6 months of the stablecoin rules, where we started off from a position where stablecoins were going to have to be 100% cash backed at the Bank of England. The newest consultation paper, or the policy paper that was released yesterday or the day before, we've managed to whittle it away down to 30% cash and 70% can be in Treasury bonds. So you can kind of see the kind of listening mode and the economic opportunity being the driver. So I think we're in this interesting balancing act where the FCA still wants to have and provide the highest bar, and the gate will be challenging to leap over. But I think the kind of economic benefit argument has been won, and we're going to see a big boom, a massive boom across structured products, and finally kind of unleash all the amazing innovation that's happened in the UK, which people have mainly, as you said, disappeared off to Dubai or somewhere else more friendly over the last. It's only the more masochistic amongst us who stayed here and toughed it out over the last 8 years. But I think it's exciting times.
And I'm just going to drill down on that a little bit. Do you perceive a lot of firms being able to successfully get through the FSMA process? So again, that I know you're saying that we're on the cusp of potentially a massive boom, but how is that bottleneck going to be resolved?
I mean, I think it's very interesting. We spent a lot of time with senior people at the FCA yesterday. We've been running roundtables. We did one with CMS yesterday with various. We've done other roundtables with law firms recently, where we've had customers in. Actually, I should have brought the QR code if anybody would like to answer our authorization readiness survey. You can see me or my colleague Daniel. Daniel, wave your hand at the back. He can give you a QR code and to do our authorization readiness survey, which we'll be sharing with the FCA and others. So I would say preparedness probably, and one of the survey questions, I can't remember the exact percentages, but it's almost evenly split between not done anything at all yet, because we're in a panic, and it all feels too daunting, starting to prepare, or feeling like people have done the work. It's a big jump moving from a money laundering regime
E-money
into FSMA is a jump, but it's not an impossible jump, and the FCA is keen, particularly that registered firms, and particularly registered firms that don't have any black marks against their name, over the last 7 years, get through the gateway. The firms that are under the most threat are the ones who've been using the S21 approver loophole to operate in the UK from overseas, with all the usual nefarious structures and multi-jurisdictional structures around how money's moved around, etc., etc. They're the ones I think who are going to find it the most challenging to move into this regime. One, they have to have a UK entity. Two, they're going to be on the hook if something goes wrong. We do get a Celsius Mark II at some point. There would have to be UK directors of that entity, and those people would and deservedly be in prison. So that's where we would end up. So yeah, I think overall you're going to see there'll be less choice to begin with, because you'll probably, I don't know how many firms are operating quasi-legally in the UK, or never mind the ones who've just chosen to ignore the whole S21 and FinProm thing because the FCA's been a bit toothless because they haven't had an authorization regime to really go for enforcement. I don't know, let's say there's 1,000 firms currently at the moment. You're probably going to end up with a starting point of a couple of hundred and then build back from there, which is exactly what we're seeing with MiCA at the moment. But the rebuild, the point that people have maybe not quite understood is, once you are authorised, you're authorised as a FSMA firm, and Part 4A, you can go through, you can vary your permissions, you can grow that business into being able to offer a much broader range of products, and there's further operational freedom, provided you can show you've got all the fun stuff like all the controls in place to do it. So I think we will see a narrowing of firms offering, but the products that they'll be able to offer will expand. Will expand quite quickly.
So I'm just going to stick with you just for another couple of follow-up questions.
Sure.
So are you seeing traditionally registered, regulated firms kind of expanding their product offering, and what's the regulators' kind of appetite for that?
Yeah, I mean, look, I would speak to it from a what we've seen perspective. So I would say 70% of the new leads, pipeline, opportunities, contracts, etc., that we're signing this year are from the UK regulated space. So firms that already have a MiFID license or whatever, they want to be able to offer the crypto piece. They can just go for arranging a variation of permission to allow for the arranging, and then they could work with, this is the brief promote Zumo phase, but that we would then be able to provide the rest of the services. We can do the dealing as a principal or as an agent. We can provide the custody and the prudential and the safeguarding pieces around that. So I think you're seeing that. That's quite a clear path now. If you are a firm offering other investment products and you want to add crypto, you could build it all yourself, or you can work with a third party who can plug that in. And I would say that describes most of the opportunities that we're working on at the moment. Whereas last year was all about overseas crypto businesses trying to work out how they were going to carry on operating in the UK.
So one of the things we've seen as a result of what's happened in the US is that our regulators have, in a way, pumped the brakes on some of their more aggressive enforcement or regulatory changes, not necessarily because there's been a change of appetite, but because with our proximity to the US and our interconnectivity, it's very difficult to walk in a totally different direction than the SEC and the CFTC. Do you see the UK regulators at all being impacted or kind of dealing with that struggle at all with now that the US seems to be open for business?
I think look, there's been some pretty good lobbying as an industry on the stablecoin piece. I think that the Clarity Act has definitely acted as a bit of a as a kind of a helpful nudge in the right direction. It's also something where the European regime is a bit of a mess, so there's an opportunity for the UK in stablecoins, clear and present opportunity in stablecoins to do something better than the European setup. So I think probably I think it's been helpful. It's been a helpful nudge along with kind of broader industry pressure, and also from I wasn't here unfortunately for the chat earlier, but the chap who's here from NatWest talking about the stablecoin piece being of the main interest. It's definitely helpful that the larger banks and the people being regulated by the PRA are pushing the stablecoin narrative as well. So if you think you've got like a multi-dimensional push on the stablecoin piece, and so that has been that's been, I think all of those factors have helped nudge that along, and means that we're going to have something significantly more sensible than the kind of fairly suicidal set of original suggestions that we had around stablecoins.
Right. No. So Joe, focusing on ETPs again, I think in your introductory remarks you already talked a little bit about the evolution and all the changes, including the generic listing standards, things that have facilitated the ability of ETPs to come to market, and the current change in the regulatory regime as well. So I'm going to shift the question a little bit because you've kind of addressed that. Similar to the question we just discussed, are you seeing, with this shift in the regulatory change in the U.S., traditional firms providing, changing their view or expanding their exposure to crypto assets in different ways to give their clients the ability to have that exposure? Are you seeing any major change there?
I mean, I think that Bitcoin and ETH, are going to continue to, to dominate. I think what you're seeing a lot of on the supply side, you're seeing people trying to bring altcoins to market. And as I mentioned earlier, I think you did see, some adoption of Solana there. I personally have a big, I think there's a question mark over whether the world of altcoins, what happens to that world? Does it even survive? By altcoins, I basically mean anything other than Bitcoin or ETH. Mm-hmm. And I spent a good 10 years writing memos to the SEC, writing memos for clients, explaining why particular tokens were not securities, and we always had to fall back on the argument that there was utility, and that utility often involved a consumer usage or something. And I think it's quite ominous, frankly, that we're now 18 months into the new regulatory posture, and I don't know, maybe somebody else has seen something out there. I couldn't point to an altcoin that actually has a real consumer use that's got a lot of uptake. And I think that's incredibly, as I said, ominous for the industry. Anywhere from, a third to maybe a quarter of the market, of the total market cap of the industry, or more than a third to a half of the market cap of the if you look on coinmarketcap.com, is made up of altcoins. Mm-hmm. And if people suddenly start to think, wait a minute, these are nothing more than lottery tickets or gambling chips, I think you certainly won't see institutional demand moving into that space. And you have to question who the retail buyer is going to be for that. Oh, wait a minute, you mean these coins aren't actually useful for anything? So I think that's a real question. And I think it's on the industry to come up with, use cases. But again, we always had to argue because of the way the securities laws, the common law tests work, that people were buying these tokens for consumption, not for speculation. And believe me, we always heavily caveated it because we always thought, well, maybe that's really not true. But that was certainly what the developers were saying, what the protocol developers were saying, and what our clients were telling us. But I think, I'm not sure there's been any proof in the pudding here in the last 18 months. And so I think that's a huge risk. So putting all of that aside, and if you just focus on the Bitcoin and the ETH products, which I think, Bitcoin, whatever you want to say about it, I think it has proven itself as a, digital gold. There's a scarcity element to it. It's obviously a lot more volatile than gold is, but just, we've seen it have massive run-ups, and certainly Mr. Saylor is saying that it's going to go to, I don't know, as late as $8 or $9 million. So I think that there's going to continue to be investment demand for the asset class in general from both retail and institutions. And the ETPs right now are not really well suited to providing the kind of exposure to that asset that a hedge fund can provide, or that we don't. It's a limiting product. So whenever you try to add like leverage to it, or turn it into an inverse product or something like that, you're just going to continue to run into issues because ETFs just don't work terribly well for that. I think just as we've seen sort of innovation in ETFs since the very first commodity ETFs were formed in the early 2000s. I think the gold was probably the earliest one. Just as we've seen innovation in those products with sort of a gradual expansion in what you can do, I think that's where the fund's going to be in the U.S. But again, I think it's going to be focused more on Bitcoin, and for the reasons I said earlier, I have a real question as to whether the altcoins are going to survive that.
Mm-hmm. So it's interesting. I was thinking when you were giving your opening remarks, how are you advising your clients in this climate? So
include lots of risk factors.
Writing all those memos and making all these arguments, and all of a sudden, somebody waves a wand and nothing is a security anymore. But you did say things could change, and then all these ETPs are illegal because the underlying, assets are securities.
So when I'm talking to clients in the industry, I'm always cognizant of the fact that I'm a lawyer. I'm not a commercial person, and I just will put this question, to my clients, and they'll often say, that's a pretty good question. I think my own view, and this is my view just as a layman, really, in terms of these commercial issues, because again, I'm just a simple country lawyer. I think I think there's sort of two branches where there still remains a lot of value to be created, and they're not the altcoins. I think the underlying technology, the distributed ledger technology, we haven't seen the wide commercial adoption of that. 15 years ago, they used to talk about like Maersk making every, container, giving it a blockchain address. And I still think that, ledger technology is powerful and it's useful. I mean, it goes all the way back to Hammurabi, right? This is a human invention that is very useful. So I still think that there's a lot to work on there. And I think that bleeds directly into tokenization, by which we mean putting equities and other kinds of securities onto a blockchain. And my client Securitize is about to complete their de-SPAC, and Securitize and other companies like that are in that space, I think could be really useful in getting traditional securities markets into a trading environment that takes us outside of the currently very creaky in the United States sort of national market system with DTC and all that. So I think distributed ledger technology, could really revolutionize the way financial markets work, with a helpful assist from the SEC and innovation by major players, which we certainly are seeing lots of interest by major players in those kinds of products. So that's one area that I think is really poised for innovation and growth. And the other areas, like you were saying, is stable coins. Mm-hmm. We're working on a couple of major sort of stablecoin industry projects. I think they've been sort of leaked to the press, so it's sort of out there right now. But I think finding a good challenger to Tether, which has some very well-known question marks about it. Finding a product that is well regulated and that is not sort of most use to in ransomware applications, for example, or in money laundering applications, which certainly that's been the rap on certainly the Tether product over the years. Obviously, that is not their business objective, or hopefully it's not the biggest use case for it. But I think bringing stablecoins into real life, and now it takes me 5 days to get a deposit or to get a transfer from my Citibank account to my Venmo account. Literally 5 days, and that's just crazy. And I ought to be able to take a stable coin and use that to pay for something. So that's where so those are the two sort of trunks that I think are going to grow out of this stump right now. But I really, again, I keep saying this, I really do wonder what's going to become of the entire altcoin market.
So, Charles, just kind of taking that segue into, keeping on the theme around the operational risk, what are you seeing from your institutional investors? What kind of questions are they asking? What are they concerned about?
So, counterparty risk has always been the biggest issue that faces this space. I think it's been the biggest issue facing retail investors and institutional investors all the way up to the biggest banks in the planet. Custody, collateral risk, and exchange risk. Is your form of collateral for trading Tether? Is Tether going to depeg? And views have always been wide-ranging and pretty interesting. So, Tether's a great example. In Europe and America, I feel like we're all pretty much agreed. Like USDC and regulated stablecoins are better than Tether. You go to...
Yeah, which one's bigger?
Yeah, exactly. And you go out to Asia and you speak to a wealth manager there and they say, why do you use USDC? That has a terrible track record. It depegged and was trading at 94 cents for 3 days. Tether's never done that, and it's been around twice as long and has deeper liquidity. And it can be a tough argument that ultimately the reach of the US government led to Circle having deposits in Silicon Valley Bank, which led to it depegging. And meanwhile, Tether's making more money than any company has ever made with 30 employees. So it's an interesting landscape, but I think coming back to those three things, that has always been
I think one answer to that is maybe the people who hold Tether really can't sell it because they don't have banks to go to, or they can't use regulated stable coins. That might be one answer to that question.
That was definitely the truth six years ago, but now as Cantor Fitzgerald and the old Cantor Fitzgerald bosses in the White House, I think that's probably a bit different these days. But yes, I keep coming back to custody, exchange risk, and collateral risk. I think custody has always been the number one issue facing the space. People, or at least average everyday investors, don't really think about the custody of traditional assets. That trust has already been built that, wherever you're custodying your, whether it's FX, whatever you may be, it's safe. Whether it's with State Street, Bank of New York, it's safe. But with crypto, suddenly it's this completely new thing, and people are thinking about private keys, and people are thinking about, Trezors and hardware wallets and stuff like this, and where you should keep it. And I think that's still the same today. I used to spend 70% of my meetings with institutions and banks speaking about custody. Now I think that's gone down to 30%, maybe 40%.
And the crazy thing, I think one of the most boneheaded things that the SEC ever did regarding custody was SAB 121, which was the rule that the gap principle that would require you to gross up your balance sheet. If you just had any responsibility at all for safeguarding crypto assets, you had to gross up your balance sheet for the value of those things. And what that did perversely was keep all of the legitimate players out of the market. And it was SAB 121 was terrible for a whole lot of reasons, but I don't think that they predicted that what they were really doing was injecting risk into the market by keeping, the Bank of New York type folks out of the market. And so one of the best things I think that the Atkins SEC did on, I think, day one or day two was repeal it. And ever since then we have seen, and then at the SEC, the SEC Investment Management Division also sort of green-lighted state trust companies as being okay for asset managers to hold client assets in. And I think broadening the custodial base and bringing in more traditional, perhaps more prudent, but certainly more trusted and known custodians, sort of apart from the crypto natives, the BitGos and the Anchorages and things like that. I think that's had a real impact. And that may be one of the major reasons why you're finding, asset allocators not drilling you about crypto custody. We've never actually had, and you'd have to go all the way back to Mount Gox or something like that to find a problem where the custody just completely dropped. And we've never really had a huge custody problem with a custodian sort of like going bankrupt or something like that. But that's been a big worry for a long time, and hopefully we never will have it. And I certainly think that bringing more respected institutional players into the custody market has been a real positive development.
And are you seeing that, Charles? Is it anything changed?
100%.
Yeah.
I mean, I was going to say next, the question is, when will I stop spending my time on custody? And the answer I was going to give is when I get asked who's your custodian and I say Bank of New York or State Street, that's
Right.
when people will stop asking, okay, so what's going on beneath them? And you're absolutely right, like Anchorage, BitGo, these have federal banking licenses now in the US. They've built great technology. They've never had any issues. But the issue is that when I speak to a Japanese pension fund,
Reputation.
they haven't heard of those names.
Yeah.
And actually we've started using some much more traditional counterparties. BBVA, Signum, which is still a kind of, I'd say more of a crypto native organization, but looks and talks more like a traditional bank, and BIDL, right? So BlackRock tokenized one of their money market funds using Securitize. And I think we've been the biggest user of that since inception. And when I get asked now, what's your form of collateral? Instead of saying Tether or USDC, I say BIDL. And, people go, what's BIDL? I say, it's BlackRock's tokenized money market. And they go, okay, great, tick. And it's like, they don't care where it's custodied. They don't care if it's in a Copper wallet or a Firebox wallet. They trust that, okay, BlackRock have slapped their name on it, so I must be able to get my funds out if something happens, and the whole of the crypto universe just magically blows up. And we are getting, I think, really, really close to that. Really close to that.
Okay, so I'm going to give you the last comment before we turn it to the floor. What are you seeing in terms of institutional grade custody on technological advancements or developments in your space?
Yeah, I mean, I think that the technology leap has been made, right? And Charles has said, if you look at any of those, BitGo, Copper, Fireblocks, it's a technology provider, but they're all providing like super advanced levels of MPC. None of them have ever had any significant, issues from a security perspective. I think it's partly reputational and partly, governance, just a bit more kind of grown-up governance and reputation around that, and that will come in time. Those reputations for the traditional custodians have been won over a long period of time. Probably the one thing we are seeing, and certainly something that we have done to partly assuage these risks, is we have spent the last year building a ledger solution that allows us to use 5 now different custodians, 5 underlying custodians, and move funds very, very easily around those based on somebody's risk appetite, perceived risk appetite, levels of insurance that a different provider can offer, whether it fits for a particular jurisdiction. And again, that fits into the traditional world, and you probably don't have your 100 billion quid all sat with one custodian. You're likely to be using several sub-custodians sitting underneath SCI or whoever it is in the investment management world. So we're trying to kind of replicate that same approach. So we're like custodian of record in the UK, but we'll split funds across, just from a risk perspective. So I think you'll see that. I mean, again, Copper have done the same with Clearloop. They're kind of moving out from that custody space in terms of being able to say, well, hold on, the real world likes a balanced set of underlying custodians. So that's been our approach. And I think that's probably one of the biggest shifts, is that because outside the crypto world, people just want to know that the funds are safe and that the governance structure is right around it. They're not attached in the way that crypto people are to particular weird tokens or technology solutions that go from that. So that would be the.
And you're seeing these worlds converge.
Yeah, of course.
That's the end game, is that all these companies are one, and I think we're starting to see that. Standard Chartered just acquired a crypto custodian that they invested in many years ago.
Yeah.
I think we'll see, especially all of the actually mid-tier, so great technology, but they've really struggled to acquire clients. Yeah. I think the big banks will come in, they'll buy them for their tech, they'll introduce their governance processes. And then before you know it, these kind of, the difference between a crypto native custodian and a traditional bank that's got a crypto product, those lines will become very, very blurry. And actually the space has been, custody is the first play. If you're a traditional bank, custody is the first thing that you're going to get into. Because until you can look after assets, how are you going to start offering products for them?
It's also the core monetization exercise, right?
Yes.
So, from a bank perspective. So.
True. Which they're very good at.
Yeah, and particularly we're moving into this world where, these assets are now being thought of as just another element that can be collateralized and generate yield against, along with a bank of other assets. Then deepness of liquidity and volume is what's going to drive the better yields, and we're already seeing that. BlackRock obviously being the key example.
Right. Great. So I think we're at time. I don't know if maybe we could take one question from the audience. If not, we will wrap up. Yes.
Thank you. I'll try to be as brief as possible. I'm a South African lawyer, part of a Pan-African law firm. Just one question to you, and that is the critique and the criticism against using the Howey test to categorize something as a security. And I fully accept that it gives rise to all kinds of unintended consequences. But accepting, as I think many regulators do, that we must look at the function rather at the institution. We must accept that while the technology is new, lots of it is really just putting new wine into old bottles. So accepting that you are getting clarification on the clarity legislation, which we don't have, what other test would you propound for classifying something as a security, if not adopting a functional approach?
So I would just avoid the question entirely, honestly, and just say I'm not going to ask whether this is a security or not a security. Instead, I'm going to look at this asset and recognize that it creates investor protection risks. It creates financial systemic risks. It creates market manipulation risks, and then just regulate it. To address those issues and get away from this tired old question of is it a security or is it a commodity. I think it's the problem with the Howey test is that we can all recite it and we can all make arguments on one side or the other, but you never have ex ante certainty over what the regulatory status of your product is. So I say, forget all of that. It's a digital asset. What are the risks it poses? Let's regulate against that set of risks.
Thank you.
Thank you very much to the panel, and thank you to all of you as well.